Right, friends, welcome once again. Just before I start the whole section, I just want to bring this across. So, the auditing manual or the auditing module, you cannot just rely on the slides. There are some students who just want to rely on the slides and the lecture materials. That's not enough, okay? That's not enough. It will be better you get a textbook that will guide you. The slides are summarized. Okay, some computations are supposed to be illustrated for you to see. The tutorial sessions will do that. The class examples will ask you to do some, and then of course we'll look at it. But it will always be better if you have a textbook. I have about 7 different textbooks on auditing, 7 different textbooks. Okay, the Millichamp and Taylor alone, I have about 3, the various versions. I have the ACC Advanced and then the ACCA, the normal auditing assurance. I have other textbooks on auditing from McGraw-Hill, from Cengage, the audit process, Gray Martinson and his colleagues. So I have so many books on auditing. The good thing is that when you have different versions and different textbooks, you realize that somebody will speak more on a concept than the other. And so it helps broaden your knowledge horizon in terms of having a deeper understanding of what the model is all about. So it will always be better if you get a text. Go to the libraries. We ensured we ordered a lot of stocks for the library. So we have the core text, Millichamp and Taylor. We have Audit and Assurance, Kaplan, Audit and Assurance by BPP with their exam kits. They are all there. Please explore. All right. We're looking at the system-based approach. Auditing is now more of a system-based auditing approach. And in the past, it has been more of materiality-based. Now it has moved more into system-based because of the risk component associated with audits. And we always want to play a key role as risk assurance. Let me put it that way. So we're giving you assurance not just because we want to vouch the numbers, but I want to give you some additional value as part of our consultancy or as part of our audit work, so that you can put in safeguards to forestall any risks of fraud, any risk of business risk that could occur to the organization. All right. I'll leave one item for you to look out for. That is the last but one learning objective, which is significant deficiency. I want you to read that and find it on your own. We'll look at principles of a system-based auditing approach. System-based, which system? The internal control system, the accounting system? Yes, that's what we are talking about, okay? Emphasize the importance of communication between members of the team. I'll leave that one for you to also delve into. But of course, corroborative evidence is important. So normally you go to the audit field, and in a typical audit engagement, you will find that it's a team. Somebody will be working on payroll while somebody is working on expenses, and another person working on sales, and another person working on the receivables. It is always important that we work and collaborate. So if I am working on sales, it will be in the best interest of the audit team to ensure that I speak the same language as the one who is working on the receivables, so that they can jive. I mean, that's the importance of what we are saying here. So the main importance of communicating between audit members is to ensure that we get corroborative audit evidence to support our work. At the end of the day, bits and pieces of works which we are performing, we bring them together like a conglomerate to ensure that we have one full picture that will underpin the basis upon which we draw an audit conclusion. We want to also link audit and control objectives to assertions, to the management assertions. We'll look at that. And briefly, we'll wrap up on audit objectives, control procedures, and how we can test or audit testing procedures for 3 main components of the accounting system: purchases and expenses, revenue and payroll, okay? And then we appreciate the problems faced by auditors in smaller entities. Now, one thing about auditing is that it wants you to think ahead of time. ideally, and I'll always say this, ideally you should be doing audit in 2 terms. And one of the audit component, the main thing, like what we are looking at now, the system-based auditing of payroll, payables, and receivables, and sales, should actually be taught hand in hand with FA3, Financial Accounting 3, so that you better understand IFRS 15, revenues from contracts with customers, so that you understand the 5 steps involved in revenue recognition, so that when you are auditing revenue, you can better understand what you are doing, okay? But you've not done FE3. So when I speak about the 5 phases in revenue recognition, you will be lost. You will be at sea. But anyway, I'll touch on them briefly. You will not be examined on those 5 steps, but you'll meet it in the next semester, next term, okay? When you're dealing with FE3. Hopefully, I'll be the one teaching you. If I'm not the one, yes, somebody will take it up. Okay, you'll be fine. Auditors, we must always work with that question in mind. Don't accept anything they give to you on face value. You must always question, ask questions, dig deeper, and corroborate your evidence with your other colleagues on the team. Now, where possible, we should always corroborate this evidence with our colleagues. The idea is to ensure that we gather sufficient, appropriate audit evidence to support the opinion, the conclusions that we draw. If there are any anomalies, any unusual transactions, any abnormal transactions, which you identify during the course of the audit, of course, you talk to the client, they will give you explanations, right? But don't accept the explanations, carry out additional procedures to verify the explanations which has been given to you by the client. So always the first step is when you see, ask questions. When you ask questions, note down the questions you have asked. Follow up with management, ask them to explain. When they explain, don't accept it on face value, dig deeper, test it, conduct some substantive testing, okay? Now, on the system-based audit approach, we want to check efficiency of the internal controls on a test basis. So test internal controls, check whether they are working well. Look at account balances. So here we'll be looking at 3 main items, areas you can always see small frauds could occur. Sometimes they may not be material, but when you sum those seemingly immaterial frauds, you get a significant item, okay, which could change the whole picture. So look at sales, look at purchases, look at the wages cycle in totality. This is what we call the transaction cycle approach. We'll come to transaction cycle approach. And the system-based audit approach, we also look at substantive testing of account balances. We'll look at this. And the use of analytical review procedures. It can be costly. It requires a lot of time and investment. So we need to have an open mind. We need to invest so much time in testing to ensure we get a better picture, reduce the risk that could occur or that could before the organization. Under ISA 330, it is required as auditors, and ISA 330 talks of the auditor's response to any assessed risks. So you assess certain risks. How do I respond to them as an auditor? So it requires you that as an auditor, regardless of the risk of material misstatement which you have assessed, it is required of you, especially when you are testing or vouching or validating items in the statement of financial position in the balance sheet. Irrespective of the assessed risk, it is required of you to design and perform substantive audit procedures for each material class of accounts, transactions, account balances, and disclosure. For my field work, almost every item in the balance sheet is considered material. For my field work, any work I've done, I see that we don't give, sometimes it amounts to over-auditing. We don't give room to think that one component is immaterial. Even the cash balance per the financial statements, per the balance sheet of the company is just £200. We still validate it. It looks like 200 immaterial. We still validate it. We still go out and get bank confirmations from the banks, and we check, do some surprise cash counts and see why. Okay. Now again, we should normally look at as auditors, okay, some risk-based auditing once it ends, conduct some substantive testing. Once you've done the test of controls, regardless of the assessed risk, conduct some substantive testing. Link these to analytical review procedures and ensure that these analytical review procedures have some connection with the assessed business risks, which has come to light. Every item, like I said, on the balance sheet looks material. Test them. Test them. You remember, you know, from your FA3, even without from your FA2, even without your FA2, any accounting that you have studied from college, from the past, from secondary school, you realize that all items in the balance sheet are always carried forward. Items in the income statement, we don't carry it forward. It ends with the net profit or retained earnings. That's what we carry forward. Otherwise, everything there will leave it. So it is always important as a first step to ensure that the closing position from last year, per the statement of financial position, per the balance sheet items are correct when we are dealing with the opening balances today for this current year's audit. We carry forward last year's closing balance position to this year's opening and check as a starting point, is it correct? All right, is it correct? Now let's move on. Transaction cycle approach, like I said, it could be costly. It could amount to over-auditing. It's a lot of work. It's more like a walkthrough. Here, this approach is looking at, it's similar to system-based approach, but usually it is more of a substantive testing in a particular cycle, where you trace from origination of the transaction, of the documentation, till its final entry in the books of account. It's like a walkthrough. Now you examine transactions, you check them to the books, you vouch them, you validate them. You want to obtain evidence. Now, it is normally now used for small businesses, and especially when these small, and of course, it's not special. Of course, you find these small businesses having poor internal controls. Even if there are controls, you see management overriding it. So we normally use this transaction cycle approach for auditing of these small companies, but you not be surprised. You should not be surprised that in a big audit engagement, some of these things are done. Sometimes we try to cover it up by saying it's a walkthrough test, but it looks like a transaction cycle approach in reality. The danger is that you may end up doing so much work, you may over-audit. It's a two-way, it's like a coin. You may over-audit or you could end up understating the figures, okay? So here we need some directional testing, like tracing sales to receivables, okay? Some directional testing and subsequent events to ensure that to ensure we have met that assertion, completion, that it is already captured within your scope of work. So to ensure completion, we may want to do some directional testing, subsequent event testing to ensure that, yes, everything that is required to be included has been included. Like I said, it's generally a costly approach. It deals with time. Substantive testing are in two parts: testing the details, test of details, and analytical procedures. The import of substantive testing is to ensure we obtain sufficient, reliable, of course, appropriate audit evidence to validate the management assertions which are associated with the financial statements. So that's the main purpose over there. Hardly would you say you want to test controls and examine the existence and accuracy, and no. Substantive testing looks at the assertions, okay? Of course, if you dig deeper and take a research dive into test of controls, we want to see whether the controls are working efficiently. But if you're careful and you test that one, you realize that sometimes it could also end up validating some of the assertions, like completeness, okay, like existence. If a control exists, then of course the transactions that fall within that control would exist. Okay, so it is two ways anyway. What are some of the ways we undertake substantive testing? And I'll ask you a question. I'll leave it hanging for you to ask yourself. So we could inspect, we could observe, we could inquire and then confirm. We could also undertake some computations and then analytical review procedures. This is my question. Auditors sometimes observe cash counts. The client will do the cash count and we observe. Auditors sometimes observe, not sometimes, mostly as part of the audit work, must also observe inventory count. we observe. Of course, some auditors go to the extent of vouching themselves. Observation of cash counts, and then observation of inventory count, stock count. Is it a substantive testing, a controls testing, or both? What do you think? Think about it. All right, so analytical procedures will normally use ratios, sometimes statistical information to confirm relationships. The understanding here is that sometimes we want to compare year on year, compare last year's figures against this year's figures. We want to strike a relationship. Why are the sales figures jumping? So you could conduct a horizontal review, a horizontal analysis. You could also conduct a vertical analysis, in which case the ratios, financial ratios, become more handy, very important. I can mention ratios here because I know you've had some background information in intermediate and basic accounting, fundamental accounting. The understanding here when we conduct analytical review procedures is to help the auditors make sense of what they are doing and to be able to gather evidence from other sources. We don't just rely on the analytical review trends, the relationships which has been produced, and leave it hanging. We conduct other tests to confirm. Corroborative evidence comes in here, okay? So the technique can provide an indication of risk, which we normally plug in during the planning stage. That is why it is always important to have what? Always important to have planning analytics and then the final analytics to reconcile both ends to ensure everything is in line. Again, analytical review procedures could tell us the extent to which we can rely on the financial statement. Is it accurate? To what extent is it accurate? How reliable is it? Can we place reliance on it? Sometimes without, like I said, we look at relationships. Sometimes we can also compare the performance, the ratios, the statistical metrics we've generated from the ARs, analytical reviews, to industry benchmarks, industry averages, to what our competitors have produced, and investigate any variances. With these investigations, you ask the client to explain. And when they explain, don't accept it on face value. Professional skepticism, dig deeper, find other corroborative evidences to support what they are saying. Okay. Let's look at purchases. Then we'll move to sales. Then we'll go to payroll. Then we'll wrap up. Okay. Now, it's a flip. It's a flip. Let me just put it this way. What I purchase is actually a sale by somebody. So the controls, the testing of the audit testing are almost the same. One is just a mirror of the other. Okay. So under purchase orders, so I want to purchase something, the order that I place. As an auditor, check when you are testing the controls, check the sequencing of the order. Are the orders serially pre-numbered in sequence? Did somebody approve it? The person who approved it, did he approve it in line with his authority limit? If I can sign up to 10,000 for a purchase, did I sign for 15,000? Did the board approve it for me to exceed my authority limit? Once we purchase the items, we expect some delivery to be sent to us. You get the GRNs, the good receipt notes. Check the sequence. Normally, the GRNs should also be sequentially pre-numbered in sequence. Check it. Or is it haphazardly numbered? The one who sold the goods to us will also send a goods delivery note. Take his GRN, his delivery note, reconcile it with your order. And of course, check it to the invoices which will be sent to you by the supplier. Check delivery notes to the purchase ledger. Here, when we make payments, you also have to check whether the payment we have made matches with the invoice we received, matches with the order we placed. Three-way match, okay? So in purchase control over the purchases, it's always important to undertake or conduct that three-way match. The order we placed, the details, do some cash checking as well. Check the sequence, check the numbering, together with the invoice which was raised by the supplier who sent it to us. You also have to try to do an underground matching of that invoice with the GRN, goods receipt notes, okay? And then you match it up to the payments which was made by the accounts. You should always obtain evidence of matching the GRN to order, check additions, calculations, any account coding with your chart of accounts. And initial, and anyone who normally receives the goods will initial, okay? And check for approval for processing. Sometimes we purchase items, we don't like it because it's of a poor quality or it's not what we wanted. We return it. We expect the supplier to issue us with a credit note to reduce our bill. So check the credit notes. Is there any evidence that we really sent the goods out? So I'm speaking like the client. But as an auditor, if you want to get a very good picture, put yourself in the shoes of the client. Is that not what we are being taught in accounting? You are the company. Put yourself in the shoes of the client. You are providing some consultancy, some advisory service, some assurance service. So put yourself in the shoes of the client. And if something is not working, tell them. All right. That's why you see companies would always want to hire auditors to become their financial controllers because they know themselves. The auditor behaves like the client and puts himself in the shoes of the client. So if I pick you to come, you already know my system. You speak like I do, and you can always do what I do better than I do. Check the payables ledger, reconcile the ledger to the control account. Suppliers will always have their statements to tell you that this amount of goods were dispatched to Richard. He paid this amount. We issued a credit note because of the goods he returned. Check their statement to yours. To your statement, okay, to your balances, whether it's your control account or your final accounts, check it and make sure they jive. Is there any authorization? Maybe there's been some addition, some subtraction, some adjustments. Who authorized them? Who authorized them? Expenses would also match with purchases. Purchases is more or less an expense, which we normally charge it to the profit and loss account. So let's try plugging expenses here, then we can jump on to the sales, okay? So confirm correct disclosures in accordance with relevant standards. If I go borrow money from the bank to undertake a construction project, and I try to capitalize the interest component on it, for what reason would I try to capitalize the interest on the borrowed amount? Does it match with IAS 23 borrowing costs? Okay. If I try to capitalize an in-house asset, which I developed, a brand, a patent, does it match with IAS 38? Intangible assets. Does it meet the pirate criteria to ensure that, yes, we can capitalize this intangible asset? Ask yourself those questions and match them. So you cannot do proper auditing without understanding the accounting standards. You cannot do that. You'll be poor. It will be strange for you to score so much grades, higher grades in auditing when you don't understand your accounting standards. What are you auditing? You are not auditing law or science. You're auditing accounting. So you must understand accounting standards and keep them hand in hand, okay? Mostly, we verify these expenses through analytical reviews and we vouch them by tracing them to the source documentations. Ensure that these expenses are correctly treated. Like I said, beware. Expenses and assets are all debit. They all have debit entries. So if I want to reduce my expenses and get a bigger profit, the only thing I could do is if Ken is not taken, I'll charge it to an asset. After all, it jives. Debit, they all jive. Okay, so be careful. Clients could end up capitalizing when they are not supposed to capitalize. Revenue recognition. So here I was talking of IFRS 15, okay, which is also revenue, which we generate from contract with customers, okay. If you understand IAS 18, you should also better understand something about IFRS 15. Here, revenue recognition, the testing is typically to look at completeness. Have we included everything? Have we included everything? IAS 18 says that revenue is any gross inflow, economic inflow, which arises from ordinary activities of the company. This inflow will result in increase in our equity. Increase in our equity, not as a result of somebody contributing extra equity, But because this revenue will finally drill down to become a profit and become what? A retained earnings, which will add up to our equity. That's what IAS 18 is talking about. And it has three legs: sale of goods, rendering services, interest, royalties, and dividends. Okay. And when you do the advanced financial reporting, IFRS 15 will tell you there are 5 steps in terms of revenue recognition when it comes to contract with customers, rendering of services. Okay. And those I'm not coming to say we should go and study that one, but you meet it, okay, where you have to establish there's a contract between you and the client. Obligations are established, contract price has been set, we allocate the contract price, and we ensure that performance has been done, okay? We'll come to that one later on when you do your FE3. Now, sale of goods. We should only recognize this when significant risk has been transferred to somebody who sold. It's gone out, okay? We no longer have anything to do with the goods. I sell this phone to the person, I've sold it. I don't need to say, can you give me the phone for me to use in making 1 or 2 calls? No, I've sold it, it's gone. No more involvement with assets, okay? With the good which we have sold. We can measure the revenue reliably, and of course, it will bring in future economic benefits to the company, and we can again measure any cost incurred in selling these goods reliably. When we render service, we must look at the stage of completion. If I'm building a bridge, constructing a road, at any stage, if I finish 40%, I must get a revenue that corresponds to the 40% work completed. That's why I'm saying, if you look at IFRS 15 revenue from contract with customers, you'll find these stages of completion. It can be a bit technical, a little technical, not too much technical. It's a little technical, not too much, but it's easy to walk through, all right? So look at, can you measure the revenue reliably? Would it bring future economic benefits to the company? Any cost associated with the rendering of service, can you measure it reliably? And the stage of completion at the balance sheet date, can we measure it reliably? If yes, recognize it, okay? Reliable estimates are possible when each party enforces its rights, okay? And this is what I'm talking about, the 5 stages, but I don't want you to worry your head so much in terms of this stage of completion. You'll not be examined on this IFRS 15, okay? So consideration remains unchanged, and manner and items of settlement are also reliable, okay? I'll leave those ones. Now, sometimes we get interest, we get royalties, we get dividends. Their income, their revenue, sort of. Now, when this occurs, when do we recognize it again? Ensure that it flows. Future economic benefit flows to you. We saw it, right, in the definition of under IAS 18. And we can also measure it reliably. Recognize it on the basis of time apportionment. Pro rata. If the interest to be recognized was for 12 months and we only earned it for 9 months, pro rata, time apportionment. Royalties, accruals basis per agreement, not cash basis, Dividends, once we can establish that dividends, the shareholder has the right to receive payments. That's an income, that's a revenue. Recognize it, okay. Basis of audit, usually by analytical reviews. So you have lots of information from the budgets they prepare, their monthly account, their last year figures. You should also establish logical relationships. So my sales, well, what do I sell? I sell stocks of goods. Trace it to that one. My sales, I sell and I get cash. Trace it to the cash. My sale, I sell and somebody doesn't pay me. Trace it to the trade debtors. So logical relationships, trace them. It can be difficult when we are dealing with construction companies, complex transactions. That could be difficult, but there's always a way out. Now, in that case, consider if the basis of recognition is reasonable. For example, if it is in stages, and agree that the revenue is recognized with documentation. If I tell you I finished 40%, I need to provide certificates of work completed to that 40% to get my revenue. There are a lot of internal control questions, or internal control evaluation questions that you could ask for revenue. So I'm going to run through this quickly. Are all sales orders approved by credit control as an indication that credit approval has been given? Are all sales initiated by an authorized person? Are Are they sequentially pre-numbered, the dispatch notes? Okay, do we check the details independently? Check for any missing dispatch notes. Do we do that? Are dispatch notes also sequentially pre-numbered? And do we have this evidence on sales orders? The inventories items, the inventory items, are they selected for all orders independently checked to the dispatch notes? And are all dispatch notes signed by the preparer and the checker? The other things we could also look at are goods being dispatch checked at the gate against details on the authorized dispatch notes. Are customer signatures obtained on the proof of delivery copy of the dispatch note as evidence of delivery? Are all sequentially pre-numbered sales invoices prepared for all dispatch notes? Are these sequence checked for missing invoices? And are invoice details independently agreed for calculations to sales orders, to dispatch notes? Check all of this. Again, you could also consider, are sales invoice numbers evidenced on all dispatch notes? Is there proper segregation of duties between those responsible for preparing the sales orders, for authorizing the sales orders, the custody and dispatching of the sales of the goods, and the preparation of sales invoices? Or is it one person who does multiple functions? You could also ask, are goods sold without proper authorization? Can goods be dispatched without being invoiced? Can goods be invoiced without being recorded at the correct amount? Can debtors' accounts be improperly credited? Can debts go uncollected and still we do not recognize bad debts in our books? Can cash and checks be received but not properly recorded? Can debtors be shown in the financial statement at amounts which are over or understated? And how will this occur? If you don't do proper reconciliation, they would surely occur. Now, we also look at audit approach for revenues and receivables. They are linked, are they not? So sales and receipts from customers approach will be compliance testing of controls. Receivable accounts, they'll be subject to substantive testing of balances. And sometimes you need to obtain independent confirmation from these. Of course, we sample some, not all of them, significant balances. So you sample some and confirm the balances with these receivables, with the debtors. So this is what we normally term secularization, and conduct agent analysis. Who owes us in excess of the required time limit? And if you have unfavorable agent balances, then it tells you that your cash collection system is very poor and you could be doomed. When we sell, I told you, it's just the opposite of the purchases. Your sales is someone's purchase. Your purchases is someone's sales. So for the sales orders, check that the orders are sequentially pre-numbered. Check that who has approved this sale to be sanctioned. When we sell, we dispatch the goods. We dispatch the goods and we attach a dispatch note. To us, it's a dispatch note. To the one who receives, it's a receipt note. Okay, goods delivery note. Okay. Check the sequence. Are they sequentially pre-numbered? Does the customer sign off when he receives the items? Match. Is there any evidence of matching the sales invoice to the customer order? Three-way match. Is there any evidence? For the sales invoices which has been raised, test again that it is sequentially pre-numbered. Match the order to the note, the dispatch order from us, the dispatch note from us to the sales order from the customer. Check additions and calculations. Have we coded it correctly in our chart of accounts? And has somebody initialed for work done and any approval for processing these sales? Check all of this. Sometimes we sell. Customers are not happy with the goods, just as we also buy, and we are not happy with the goods. And they'll return the goods to us. We must give them a credit note. Check for evidence of goods returned by the customer, and then ensure that the reason for which they are returned it is reasonable, and issue the credit note. Match the credit notes to this. In the sales ledger, we must populate this. Check your sales ledger, evidence of reconciliation to the control account. Have there been some discounts given to some customers? Is it reasonable? Statements sent to customers, and then of course, if there's been any adjustment, who authorized it. We are wrapping up. Payroll, very important. Very important. The objective of payroll is to ensure that we pay people for work done, and to ensure that payments are made in return to value received for work done. If I don't teach, why should I be paid? If I don't work, why should I be paid? Ensure that payments are made to the correct employees. I don't work and then somebody takes the pay. Sometimes there are ghost names. People have left the company and still they pay them. Ensure that payroll costs are completely and accurately recorded in the financial statement. So you can say we are looking at existence. Are you paying the correct person? We are looking at completeness. Is everyone included? We are looking at accuracy. Are you doing the correct calculations? The liabilities, the pay as you earn, the income tax, the national insurance contribution, the pension contributions, the statutory mandatory contributions, deductions. Are they correct? And are they paid on time? Sample ICQ questions for payroll. Can employees be paid for work not performed? It can happen. Can employees be overpaid or underpaid for work performed? Yes, it can happen. Especially timesheet, somebody will key in a timesheet when he knows he has not done that work. Can wages be stolen or misappropriated? Yes, somebody has left the job and they are still paying and somebody is taking the money. Can wages be paid to persons other than those employees entitled to receive? Can I work and somebody take the pay? Yes, it happens. Can somebody do wrong calculations for my gross pay, deductions, my statutory deductions and net pay, and can it go undetected? Yes, if you don't do a good job, you can find this happening. Can payroll transactions go unrecorded in the accounting records? Sometimes. Can incorrect or out-of-date personal details such as pay rates, promotions, status, leavers be used in the preparation of the payroll? Yes. Somebody will say he has one job when he's got two jobs to just evade the tax system. Cash system, of course, all that we are saying, there will be cash. If you purchase if you purchase on credit, one day you end up paying cash. If you sell on credit, one day you end up receiving cash. You pay payroll, it's cash. So the control objectives under cash is to ensure that all cash receipts are properly collected, recorded, and banked. If you give me loose cash, if you let cash walk about loosely, people will steal. People will defraud the system. So then another control is to ensure that payments made to suppliers are in respect of invoices raised by them only. We don't pay them for no work done or no goods supplied to us. To ensure that amounts we charge to the bank statements are authorized. Okay, to authorize. If I'm paying you salary, it's authorized for work done. Ensure that receipts and payments are accurately recorded and completely recorded in the accounting system. Cash here, we're not dealing with only the paper cash that, we're dealing with coins, we're dealing with the bank transfers, everything that goes through our cash and bank system. Audit controls we can put in, then we wrap up. So if there are cash receipts by post, ensure that you attend mail opening and ensure procedures are followed, normally not by one person handling the cash. Independent test check of cash receipts to bank deposits. So segregation of duties is very important here. And obtain evidence that receipts for cash are pre-numbered. Test for arithmetic accuracy of cash received records. Okay, are there any blank checks? Okay, cash payments. So we're dealing with the cash receipts over here. Cash payments, inspect current check runs and inspect that checks are used in sequence. Are there blank checks with signatures, open checks? That could be dangerous. If there are some checks which have not been used, have they been destroyed, spoiled? Do we log checks in the check logbook? Test procedures to ensure that invoices are not paid twice. And arithmetic accuracy of any cash payments is very important. Who orders for cash to be paid? Check the authority of standing order and direct debits. Who ordered this to be instituted? All right. And then finally, we're dealing with small company audits. Small companies, usually they may not have controls, or their controls may not be working. Even the controls are there, management could override it. And they always have issues with going concern and uncertainty. Somebody said, and I agree, The main purpose of accounting is to ensure going concern that our company would at least survive into the foreseeable future period. The next 12 months, the company should survive. Small companies, sometimes they lack this foresight. The engagement letter is required for either big companies or small company audits. Check. With the engagement letter should specify the boundaries. Make sure you are not auditing your own. Sometimes because they're a small company, you provide them with advisory and you still audit them, self-review threats. Do not be involved in management decisions and ensure you are not acting as advocate for the clients. Ensure there's no loss of independence through involvement in client affairs, okay? So it's very important. You may have read the recent story about Deloitte in China, where they asked the clients to audit themselves and to issue a clean report for themselves. And they've been fined about $31 million for that crazy thing that they did. So that's a big four audit firm. Can you imagine allowing the client to audit themselves? Okay, take a good look at case study Suti and Sweep. Self-testing questions on pages 220. There are some too detailed questions on pages 221 to 223, centered on Chagley and Chamomile Limited. Take time to review this. All right, so system-based auditing is important. We can never look down upon that. So we've gone past. There's a detailed one, and I leave it for you to review. No further comments on this one. Please read. Take the books, visit the libraries, use the textbooks. You cannot just rely on the slides. Remember your foreknowledge in accounting, and you'll be fine. All the best, and see you soon. Bye.